having the money sit in there and grow and compound for you is great. But the real power of this is law number 2 right there, with the ability to pull it out while the money continues to compound and use that money for other things. So that's what we call the infinite banking concept, or IBC. That's where that comes from, is this strategy of using that money from the policy to do other things. Now, when it comes to the infinite banking concept, there's literally an infinite amount of ways that you can use these policies, from everything from everyday bills to investments to paying debt and everything in between. Now,
welcome back. Another week of Wealth Webinar. And you know, the topic of the hour, of the day, of the week, of the month is, what do I do with my money? The markets are chaotic, to say the least, up, down, sideways, mostly down. People are getting their statements and going, holy crap, honey, we got a problem. Houston, there's a problem here. So today, what we're going to do, or what Steven's going to primarily do, I'm just here for backup vocals today. Steven's going to show you what to do to preserve and protect your wealth the same way the banks do, the same way the wealthy do. And this is what you need to do if you want to be ready for what's next. And what's next, if you ask me and all the other people that we surround ourselves with, it isn't going to be pretty. So Steven, let me turn it over to you.
yeah, definitely. And so, hey, how's everybody doing? So if you were on last night on the Tuesday webinar that we did, got into a little bit about, the infinite banking concept and how we take these specially designed and engineered whole life policies and how we start to build those for banking purposes and why we do that. And then, looking at, using the money in those policies to be able to move that money, keep that money moving with the money movement, because money in motion is going to always make more money, where money sitting still is going to be losing money for you, especially in these, the times that we live in right now with the record inflation and everything going on. So because of the volatility in the markets, because of the elections coming up next week, and who knows what's going to happen after those things are done, I think a lot of this is being propped up just to get through the elections next week. And then what goes on from there, it's anybody's guess at this point. And I've had a lot of really good conversations lately about the real estate markets, what's going to happen with real estate prices and investments, what's going to happen with stocks. What should we be doing right now? Should we leave our money in the stock market? Should we let it ride over time? Should we take it out now? Like, where are we? So I told Chris, I said, Chris, let's talk about this stuff. Let's dig into it kind of deep. Now, I will say we only have about an hour and a half today on this webinar. And in a week and a half from now, we're going to spend 3 full days really diving in deep about everything that we're kind of hitting surface level today. So if you like what you hear today, make sure you join us in next weekend on November 11th, 12th, and 13th for our 3-day Money School Essentials training. And that's where we get in deep on these subjects, even deeper than we're going today, as well as bring on other experts in those areas that we're going to talk a little bit about today. So today's gonna be really good. And we're getting into infinite banking and primary real estate today. All right. So with that being said, I don't know, Chris, if you want to do some drawing on your board back there, if you want me to pull the whiteboard up here. But, I did something last night, and I've done it once before, and I really enjoy it. So anybody that's new on right now that wasn't here last night, this will be good for you. If you're on last night, it might be a little repeat. It'll only take about 3 minutes to do, though, Chris. But what I like to do is call this the perfect investment. So let's just start with what the perfect investment is. All right. So in the chat box, when you think of a perfect investment, list out some things, what that would entail, like what that would involve, what that would include. What would that investment do for you where you would consider it a perfect investment? Put it in the chat box. And we're going to make this interactive today as well. So here we go. So Jim said, low risk, high reward.
Okay.
It never loses money. All right. What else you guys got?
Now they're asking for way too much.
Guaranteed profit. Okay. So maybe a guaranteed return. Good ROI, continues to offer value. So on that, value is kind of an objective term, but good ROI I like. Okay, Shelly had a good one. No taxes, passive income with growth, and never loses principal. So kind of that guarantee as well. Let's see. Drew put a bunch. Tax-free, we have that. Consistent returns. So we have good returns, guaranteed returns, but how about consistent returns? That's a good one. Cash flow control. And the last one, set it and forget it. Control is a good one, and then set it and forget it.
I missed one in there. I don't know what one I missed.
That's okay. Those look good. I would say control, add control on there. Do you have anything in your head, Chris, that you think would be a perfect investment?
Yeah, I'd want it to be protected. So if somebody sues me, I don't want to give it away.
Now keep that up for a minute, and then we're going to talk about that. All right. So as a lot of you guys know, and if you're new to the wealth webinar, what we do here at the Money School and the Money Multiplier is we teach you how to take back control of your money and solve your money problem. So everyone has a money problem, whether you have millions of dollars in the bank and you're looking to preserve that wealth and continue to grow it and create a legacy for your family. Maybe you're looking for that perfect investment for that money, for your wealth. Or maybe you're on the other side of the fence where you're living paycheck to paycheck right now. Maybe you're caught in the rat race. Maybe you have some debt that's built up and it's kind of holding you back from being able to grow financially. But regardless of what side of the fence that you're on, everyone has a money problem. Those money problems are different, but that's why we're all here, is to solve that money problem, whatever my and your money problem is, and then taking back control of your money. So why would we want to take back control of our money? So let me start with traditionally speaking. So traditionally in this country, when you think of investments and growing wealth, what over 90% of people do is they invest their money into things like a 401k. All right. So looking through this real fast, Chris, if you want to kind of compare a 401k to this perfect investment. All right. So just put little marks next to it. So low risk, high reward. I mean, you can maybe do low risk if you move the money around depending on what the market's doing. You can definitely lose money, so that wouldn't be there. It's not guaranteed. No taxes. In a typical traditional 401k, you are still going to pay taxes on that growth, given you're going to pay the taxes later. But that's a whole problem in itself, right, Chris? I mean, if I'm not paying taxes today, but taxes seem to continue always go up in our lifetime, then why I'm putting off paying taxes till later. So exactly. 401k might not fit there. Consistent, no. 401k is typically the stock market, so you get all the ups and downs. We're giving up control because if I want to take my money out to use it for something else, I'm going to pay a 10% penalty. Yeah, all right, so 401k.
You could set it and forget it. I wouldn't suggest it, but you could.
It has no liquidity because you're paying a penalty to take the money out.
It does have some protections, not all, but it is protected against some liens, depending on the state. So it does have some protections, not a lot though.
Okay, so we met a few of the criteria, but definitely not all of them. But at the end of the day, that's where most people are investing for their retirements, is through 401ks. Would you agree with me on that? Yeah. So why is that, Chris? And you were a high-level financial advisor for 16 years. I was for several years as well. So you have a lot of firsthand experience in this. Can you just share for a few minutes, when you used to be an advisor, you meet with clients, like what that looked like? Like you would talk to them about these kinds of things, 401ks. I guess this is a two-part question. Number one, why would you talk to them about those? And why would you recommend things like investing in the 401k? And B, what was the result of you doing that? Did you see that most people achieved their goals for retirement and were able to retire financially secure, or most people had to change things drastically or push back retirement? So what was the end result with what you were doing too, if you don't mind sharing a little bit?
So the first thing is why did we sell 401ks? Why was that a big part of our practice? It was, you make one sale to the owner of the business or, the board. And then from there, you have access to all their employees, which means you get to now have one place you go where you have access to all these employees. The owner of the company typically would say, hey, this is a good thing, blah, blah, blah. We're giving a match, all this. So all the employees just follow the leader. So it was very easy. It was fast. It was like you just got a lot of assets under management incredibly quick. And then it gave us the opportunity. This is what I like. Wasn't so much the setup of the 401k, because you didn't make a lot when people are putting $50 a week in or $100 a week. That was very slow building. But what we were able to do is meet with these people and find out who had old 401ks from old employers, and we would then roll them into the new one. So now we had bigger chunks of money. Somebody said low cost upfront and ongoing, maybe upfront in most 401ks because there's really not many upfront loaded funds. But I will tell you the ongoing expenses, especially later, like I was doing a lot with John Hancock and Principal and Vanguard. A lot of the funds that were in the 401k might upset some of you, but they were the freedom date funds, the retirement date funds that all of you have seen with Fidelity, like the target date at 2040, 2045. We would just say, hey, what year do you want to retire? And they'd be like, okay, and that's 20 years out. So we would pick a fund 20 years out. Okay, that's the 2045 fund. This fund's going to self-adjust as you get going. This is that set it and forget it. You don't ever need to do anything. You just put your money into this fund. It starts out a little riskier, and then as you get closer to retirement, it gets safer so that if the market drops, you don't lose money. What we never seemed to tell them, we'd always gave them a prospectus, but we never told them that those are by far the most expensive funds, which because they had the highest fees, I got paid the most. So a lot of times it was really just, that's why those funds were created, for the set it and forget it's, and the people that didn't want to think about it. But those are the highest, because they took management, they were the highest fees. So we ended up making a lot of money. That's why we sold them. And if I had to really look at it and just look at all the clients that I managed and say, what were the results? I mean, I went through 2 recessions as an advisor. I came in after the .com, so people got devastated there. I rode through the 2008 crash. People got devastated. And when I retired in 2018, a lot of my clients hadn't even made it back to the pre-2008 levels. So I would say, depending on the week, the month, maybe the year, that was a sliding scale. I think some people were happy because they got positive returns, but most of the time people weren't there. And I helped a lot of retirees retire. And I can tell you one thing, most of the people had goals of retirement that were far higher than what their allowable assets would give them. So their standard of living almost always dropped. I mean, I'll tell you, the ones that never seemed to have issues, the real estate investors that typically gave me hardly any money. They might open a Roth or some 529 plans with me, but they never put much money in the stock market or in 401ks. But yet when I looked at their numbers, because they would have to tell me what's your net worth, how much you have in investable assets, they were the wealthiest ones of them all, but they had the least amount of money in the things that I was selling. So I was always pissed at them.
Yeah, and if we look at the Social Security Administration, they come out with a statistic a couple of years back that say 5 out of 100 people only 5 out of 100 people will be financially secure at retirement age. So 95% of people that are doing this advice of these financial advisors, they're investing in the way that they've been told to do their whole lives, things like 401ks. When they get to that retirement age, it just doesn't happen. And so, when I say, what is the perfect investment and what's that look like to you? All these things that everybody lists, but where most people are investing, it doesn't include the majority of what makes up that perfect investment. And for me, one of the most important things about all of that on that perfect investment is number 9, control. At the end of the day, we're just giving up control of our money. We're giving up control of our wealth to other people management, other people's companies that it's going to sit in the stock market and potentially grow, things of that nature. So it's so important in my eyes to be able to understand that and then look at, okay, how can we maximize what we all are doing? Because, nobody wants, as a financial advisor, at least with me, Chris, I would always have to have the conversation. Okay, these are your goals. This is when you want to retire, but this is what you're doing today. This isn't going to happen. There's just no possible way. So you're either going to have to change your lifestyle today so you can save more money for the future, so live less of a life now, or you're going to have to push back retirement, so you're going to have to work longer, or you're going to have to take on more risk to try and invest in riskier stuff to increase those returns, or you're going to have to lower your retirement lifestyle. So you're not going to be able to make as many trips or go on those cruises or go visit your family across the country and the grandkids whenever you want to. You're going to have to change things because you just don't have the money to retire at that age. So there'd always be a give or take involved. And so, what I've learned over the last 15 years of being in this industry and being a real estate investor and studying financial education and working and partnering with people like you, Chris Naugle, is that there's a better way out there. And so what we're going to talk about today is literally how to control your wealth, how to become the bank and why you want to become the bank, and how to solve your money problem by following this process. And by doing this, you're not going to work any harder. You're not going to work any longer. You're not going to take on any more risk. We're going to do one thing. We're going to change one thing, and that's where your money goes first. And by changing that one thing of where your money goes first, that's going to create a snowball effect, a potential, a tailwind for your money for the rest of your life. That's going to be allow you to start achieving these financial goals and become part of the 5% that can retire financially secure when and how the lifestyle that you want to. And that is our goal. That is our number one thing that drives us every single day to wake up and put everything, our lives, into this business of money school, is so that you and your families can achieve financial success down the road. So with that being said, Chris,
let me hit on one thing real quick, Stephen. Somebody just commented on Ted Benna. So Ted Benna was the founder of the 401k. He admitted, and he even admitted in his book, The 501k, that the 401ks don't work for retirement. He literally says it in his book. And you should really focus on chapter 1 of his book, because he goes through, and maybe not the exact same things, but he describes a perfect investment. And he points out all the things that his people that he interviewed called out a perfect investment. Many of these were there. And then at the end of it, he said, you know, this vehicle, this machine we're going to talk about in a second, he said, this vehicle is the only one in the industry that does every single one of these. And then he says it's the Swiss Army knife of the financial industry. So that's what we're going to get to. And, you know, when we get comments that come in, you know, that are like, oh, so you're selling whole life. We're not selling anything on here. Okay. What we're doing is teaching you something that you should know, so you should learn, because if that's the way you think, you're like, oh, you're just selling whole life. And that leads me to a statement that Will Rogers said. He said, the biggest problem in America is not what people don't know. The biggest problem is what people think they know that just ain't so. I can type that out for you, Sam, and that's an important one. So please don't think you know what you don't know. We're going to teach you something that if that's what you say, that really, really contradicts all of your belief systems about what you think when you said that comment. So stay with us for that.
Yeah. And like you said, Chris, Will Rogers says it best right there up on the screen. So if you want to see that quote, that's it right there. And so, you know, when we start talking about, you know, becoming your own bank. So let's talk about that for just a second, Chris. So why would you want to become the bank? Okay. So can we all agree that banks know how to make money? All right. So what do banks do to make money? All right. So banks operate off something called a spread. And what banks do is whenever you have money, you know, 99% of people are going to take their paycheck. They're going to take their profits from a deal. They're going to take whatever money they have. They're going to go down to the bank and they're going to deposit that into their bank account. Right now, the bank doesn't take that money and literally stick it in your account and wait for you to come get it. The bank immediately takes that money and they start moving it. Okay. And they do that through different lending opportunities, things like mortgages, auto loans, debt consolidation loans, car notes. So all these different types of loans, you know, home rehab loans, you know, all these different types of loans that the banks create. And so what they do is they work up what's called a spread. So if they're paying you 1% in a savings account, and then they're lending the money out at, let's say, 7% in a home mortgage, the bank is making a 6% spread off of your money. And when you actually add up the banks and how they lend out your money, they do what's called fractional reserve banking, where they lend your money over and over and over and over and over and over and over again. At the end of the day, banks actually end up making from 400 to 1,600% off every single dollar that you park at that bank. You can go to a website, write this down. It's called BauerFinancial.com, B-A-U-E-R, BauerFinancial.com. And they'll tell you all about how the banks operate, what the banks invest in, how the banks make money. And they go in depth about all this stuff. So you guys can fact check everything that I'm telling you right now. But Bauer Financial tells us 400 to 1,600% is what banks make off of our money. So my question to you is, why are you doing that? Why are you making the banks rich? So that's question number one. Number two, we agree that banks know how to make money. Banks are making money through spreads. Well, what else? So banks invest also. Banks put their money into two assets, okay? Two different types of assets. And you guys can research this stuff as well, but over 90% of their M1 money supply goes into two different assets. Does anybody know what those are? Okay. So number one, yep, they're M1, they're tier one assets. Philip, you're absolutely right. So number one, whole life insurance. So whole life insurance, banks are the number one purchasers of whole life insurance in this country. If you've ever wondered why when you walk into a bank, a lot of the bankers, a lot of the people that work there have little name tags on that say vice president of whatever, it's because by giving that employee the title of vice president, it allows the bank to have an insurable interest on that person, and they can purchase a whole life policy on that individual now. So number one, they buy whole life, and we'll talk about this. It's something called BOLI, bank owned life insurance, BOLI. And we're going to talk in just a second why banks do this, but we agree they know how to make money. So there's a reason they're doing this, right? So number two, where they put all of their money, real estate. So think about it for a second. Where are banks located? If you look at any city in this country, in the world, really, some of the most beautiful skyscrapers, some of the most beautiful buildings in these cities are at the top of them are bank names. If you drive down the road, there's bank branches everywhere. These banks buy real estate and they invest in real estate. Why? Because banks know how to make money. So if banks are putting their money and all their assets in two places, whole life insurance and number two, real estate, do you think that maybe that's something that we should look at doing ourselves also? And why wouldn't we? Now, when it comes to being the bank, we want to be able to control our money. So I asked a second ago, why we keep giving all our money to banks where they're making 400 to 1600%. So let me ask you this question. If I could show you, can you go back to that perfect investment, Chris?
Yep.
Okay. So if I could show you a vehicle today that checks off literally every single one of those boxes, and you could use this vehicle to now become the bank. And this bank gives you an ATM machine. And every time you put money in that ATM machine, you can pull more money out of that ATM machine every single year than you put into it. And the next year, so I put $10,000 in, the next day I pull 12,000 out. I put 10,000 in the next year, the next day I pull 15,000 out. The next year I put 10,000 into that ATM machine, and the next day I pull $20,000 out. How many of you would want a bank and an ATM machine that does that for you? Everyone on here, right? And then how many of those ATM machines would you want that does that for you? So that's exactly what we're going to do. So if you look at what a whole life insurance policy allows us to do, and these are rules set by the IRS, by the federal government. Chris is putting little check marks on there right now. A whole life insurance policy gives you every single one of these advantages that we just listed out that would make up a perfect investment.
Yep. The only things that I would do, I added stars next to a few of them because the high reward. So depending on what you view as high reward, the infinite banking concept might need to be added to just the vehicle. Same thing, good ROI, like that might have to be added with what you do with the money next. Consistent returns. I mean, yes, it's consistent.
So let's talk about that. So a whole life insurance policy. So I want to clarify a couple of things right now. First off, this is not a whole life insurance policy that you go buy from policygenius.com or you call up your financial advisor or your insurance agent or your buddy from high school or your brother-in-law or whoever, okay? This is specially designed and engineered whole life policy that's built to allow you to be the bank using it as the vehicle. Okay, I just want to make that very clear. So this is what I do. This is what Chris does. This is what our entire team does at the Money Multiplier all day, every single day. So this is not your typical whole life insurance policy. And the best part is it's Halloween season right now. On Monday night, we were going around with costumes on and we were scaring people and all the craziness. So what we do is we take a whole life insurance policy and we literally murder it. We hack it up into little pieces and we destroy it to where it's not even recognizable. So the whole life insurance policies that we build for banking purposes, you would not, a typical life insurance agent would not recognize them. Would you agree with that, Chris?
Yeah. And actually, I love this topic. One of my best performing YouTube videos of all time is one that's how to build an IBC policy. So I think that's where we're going. And I mean, since we're going to, show them how we're going to murder a regular whole life, we might as well break it down and explain it. So the one thing you need to understand is a lot of people think a whole life is just a whole life is just a whole life. If there's only one design and it's the design your broke ass brother-in-law tried selling you. And that typically would be a whole life that's built solely for death benefit. In other words, the base component, that's the death benefit, right? The base death benefit is the only part of it, which results in what Dave Ramsey says. That's an overpriced, terrible insurance policy because number one, you get less death benefit than you would with a term. Okay. You have no money year one, no money year two to you. Like I'm talking about the cash value. Usually there's no money in the first really 3 years for most of them. And I was at New York Life 14 years. So I've seen a lot of whole life sold and I don't remember any of them ever having cash. We always had to go like 15, 20 years out just to make it seem sexy. And that was because I didn't understand what we understand today. So this is how it's normally sold. And I'll tell you why there's no cash value. It's because they pay a big old fat commission. So in other words, I'll just use 10 grand. If you did a regular whole life with your broke ass brother-in-law, with your no disrespect to Northwestern Mutual, a great insurance company, but they sell a lot of regular whole life. If you put 10 grand into this, that agent just made minimum $5,500. Is that a bad day in the office for the agent? Nope. What if they put 100 grand in? They made 55 grand. This is what Dave Ramsey talks about. Okay. And I would agree, like that's a terrible place to put your money by all intents and purposes, unless you're focused really heavily on the long term and the death benefit. But you know what? Hell, with all the stuff going on today, I don't know if there's going to be a long term. So I like playing the short game, not the long game. So how we do it, when Stephen says we murder it, the first thing we need to murder is we need to murder the commissionable part of the policy, which is the base. We need to reduce that down, which then reduces the commission down. So Sam was talking about this in one of the chats. He was just saying, I need to know how to design it. So Stephen, can you talk about just a few of the different designs we do on these policies, depending on the needs and goals? And I'll just write out how this works and how we build it. And then I'll show the difference between the commission that you would get here and the commission we get. And that just means that's how much money you have in your policy to use immediately in the first 30 days.
Yeah, absolutely. And just to clarify a little bit further, even it starts even before the product itself, the actual policy, it starts with the company. And so when we build these policies, we have to start with the company and see who will work with us to allow us to build a policy the way that we're going to show you in just a second, who has a long track record of being a strong company that pays out company dividends that we need for this to work. And so let me explain that a little bit more. So what we do is when we look for a company, we look for a company that has the highest financial rating. So we need to know that if we're putting our wealth into this policy, that it's with a company that's going to be there in the long term, no matter what goes on with the economy and the markets. So we look at companies like One America, also known as American United Life, companies like Lafayette Life Insurance Company that's owned by a Western and Southern Group. These are companies that have been around for 120, 150 plus years with the strongest financial ratings in this country. They also have very strong track records, 120 plus years of paying out strong annual dividends. So the way that these policies grow, and when we go back to that perfect investment in a minute, you'll see this, but the way that these policies have this tax-free, compounding, guaranteed growth within them that give us all of this ability to do all of this is it happens through the company dividends. So the insurance company has to be what's called a mutually owned, dividend-paying whole life insurance company. So that's what we look for. Make sure that they're financially secure and they have a strong track record of paying that out. So we have that consistent growth that we talked about a minute ago with the perfect investment. Okay, so check, we found those companies. And remember, the Money Multiplier has been doing this for over a decade now. So we've had thousands and thousands of clients all across the country. So we know exactly which companies are good to work with, which companies allow us to do what we need and work best for you as the client. Okay, so once we find the company, now we take this policy and we murder it, like Chris said. Okay, so what we do is we do a combination of 3 different types of premiums that make up the overall policy. And that's what's called base premium, something called paid up additions premiums, and something called term. Okay, now let me explain that. So I'm down here in South Florida, maybe about 150 miles south of Cape Canaveral. So multiple times a week, NASA and SpaceX with Elon Musk are shooting rocket ships up into the sky. And I watch them from my office, right out my window right here all the time. I can watch them shooting up into the sky. It's amazing. And so if you want to look at the insurance policy like this for just a second, when we have the rocket ship on the takeoff pad, that thing has these big rocket boosters on the side of it. Okay, so those rocket boosters kick in and they take that thing going. All right, it has to break through the gravity, it has to get up into the atmosphere, it has to break through everything. Okay, so those big rocket engines on there have all the power, all the boost, all the gasoline and everything that gets that thing up into space. But here's what happens is once that thing gets going and gets that momentum going and it gets out of the gravitational pull and up into space, Earth's atmosphere and into space, those rocket engines, all that power is no longer needed. So those rocket engines actually fall off the rocket. And then these days, Elon Musk controls them where they come back to the ground, land on the landing pads, and they use them over and over again, which is mind-blowing stuff, but that's not what we're talking about here. So anyways, so those rocket engines, if you think of a whole life policy, those rocket engines are what are called the PUAs, the paid up additions of that premium. So depending on how fast we need that rocket to get into space and how quickly we need and efficiently we need it to get there, helps us determine how much PUAs we need to put onto that rocket ship. And that can typically range anywhere from 60 to 80 to maybe 90%.
Yeah, I would say
depending.
So we'll just write that here. So 60 to 90, very few 90s, just because a lot of dump-ins, we can't do the 90%, but that's how much goes there.
Yeah, so then the base of that policy, the base rocket ship, once it's into space, then it'll take you around orbit and float around the Earth for as long as it wants to, really. It requires very little power at that point because it's already up to where it needs to go. So that's the same with the whole life policy. So those PUAs that we add on to the policy, depending on how much we need on there, once the policy gets going and becomes what we call efficient, then we can drop those paid up additions, those rocket boosters off of the policy, and then the base itself will continue to allow that policy to grow and do what it needs to do for the rest of your life. And so those PUAs are typically going to be on for 10 years, and then they're no longer needed, so they're going to drop off. So that's what this thing's going to look like. And then depending on how much PUAs we need to put on this thing, how quickly we need to get it there, things like dump ins, like extra money in the first year that we can put onto these policies, stuff like that. Remember, when we build this policy, we have to work within IRS government regulations. And there's a rule called 7702, and there's a rule called MEC, which stands for Modified Endowment Contract. So when we build one of these policies using base and PUAs, we have to work within the MEC guidelines. And those MEC guidelines determine if we might have to add a little bit of term insurance onto this policy also. Because if we put too much paid up additions and get it too efficient too quickly because we need to for you as the policyholder, well, we might have to add a little bit of term on there to keep the policy from necking. But again, just like the rocket boosters, as soon as that term is no longer needed, we're going to drop the term off. Because those rocket boosters, if we didn't drop them off, or that term, if we didn't drop it off, it would just create extra drag. And it would make the policy less efficient. So when we build these things, we're taking into account all these different little parts of it that all go together that create the perfect, so to say, investment or create a new banking policy that's built this way for banking purposes.
Yeah, it's interesting. Just the other day, so I have this client that many years ago, he's a local guy, wanted to get a policy and he got denied, and we just couldn't get him coverage because just different reasons. But he went to a local agent who I know well. And he said, hey, can you try to, I'm losing my voice, try to get me issued a policy? And they were able to. I don't know how they did it. Maybe just time passed. And he came to me and he said, hey, they got me approved. Can I just switch this over to you? Now, I'm an ethical man. Now, could I have done that and gotten the commission? Yes, the commission on that one would have been about $500. But I said to him, why don't we just keep it with them? They've done the work. They got it approved. But here's the hard part. I got to show you how to design this thing, and you got to just give this to them verbatim so they design it properly. Otherwise, they're going to design it so that it maximizes and looks more like this, which it's funny because the very first illustration they sent him was exactly this model, 100% base, hardly any money in any of the first 3 years, and a big old 55% commission on the full base. So what I had to show him how to do was how to reduce the base, which is reducing the commission. Base and commission this is where we make our money, is on the base. So if there's 40% in base, that means this agent takes a 60% cut in their pay. Then the paid up additions, we get paid a little bit, about 2% on what goes into paid up additions, but it doesn't amount to much at all. So I said, okay, then you're going to tell them to put 60% to the paid up additions, which they're going to get a reduction of 55 down to 2. And then I told them to put it in a product that reduces their commission even more, because instead of 55%, let's put it in a product that actually only pays 11. So if you're an agent and you've done all this work and you're thinking you're getting a $5,500 commission, and then all of a sudden this guy comes in and tells your client how to design it so that it benefits them, and all of a sudden now they watch their commission go from 55 to 500, the agent's pissed, but what do you think the client is? Thrilled, because when they see their statement, guess what? The difference between 5,500 and 500 is how much more money they have in their account. Plus, because the paid up additions go direct. I mean, this goes direct to cash value. So you have access to like anywhere between 90 and 90, gosh, as much as 96% of anything you put into paid up additions in the first year, like immediately. But when we design them this way, you have to understand something. You know, if the more we give up on base, the smaller we make our rocket ship, the less efficient it's going to be in the future, but the more money we get to put in the boosters. So if you want an awful lot of cash value up front, we just dial the base down. And 10 is very difficult. I just want to be clear. I know there's a lot of guys on YouTube and a lot of guys out there saying, oh, 90-10s are the best. They might be, but you can't do a dumping into a 90-10. And not only that, a 90-10 makes your base very small, and you're going to have a giant term rider. And I will tell you, like Dave Ramsey's right. The difference between a term premium and a whole life premium is drastic. There's a big difference. But what he doesn't tell you is that term insurance, as you get older, gets more expensive. So if we're building a really efficient rocket, do we want something on our rocket dragging that every year gets more expensive after a certain point? No, we want to get rid of that sucker. So if we design something with a 90-10, chances are you're going to have a big term rider. And if you're older, that's going to cost a lot of money. And if when we drop the term off, you're only left with only being able to put 10% of your desired premium into the machine. Or you can keep the term rider, but it's going to eat away at your cash value over time. We don't build plans that self-destruct in the future. You don't want to build a rocket going to the moon and then all of a sudden you're 5 miles from the moon and the damn thing explodes, do you? Well, I don't want to build them that way. So what the sweet spot's been for us is about 35, 65 with a dump in. And we've run constant amounts of numbers. We give up a little in the early cash value. I mean, not much, but we get so much more in the long run. But we have designed them 90-10. We've designed them 20-80. It all comes down to the client's needs and goals and how much money they're putting in. But this is the design. So for Sam, like this is how we design them. It's just going to be reducing the base, increasing the paid up additions, which then creates a big complexity for the agent or the person building it, which we're very, very good at. We've done, how many have we done now, Stephen? 67, 6,800 of these those are just clients. We've probably done, God, tens of thousands, of illustrations, but we have like over 60, I think it's, I got to look, 6,700, 6,800 clients and climbing every day. We know how to design this very efficiently, but if you take a person like that one guy, if you don't tell them exactly what to do, they're not going to know how to do this because they're going to say, you can't just put 40% and 60 here. It's going to mech. Well, that means we got to add a term rider. And if we know what the mech rule is, how much the IRS says that we have to have in death benefit, we want the least amount to the expensive death benefit, the most amount to the term cheap one, but we only want the term on there between 7 and 10 years. And we want that, it's actually 8 years I got to put because you can't get rid of it in the 7th. 8 years. Why 8 years? It's a MEC 7 pay, meaning for 7 years, the test goes on. In the 8th year, we can drop the term. And now we've got ourselves a crazy, crazy efficient machine that produces returns like nothing else you've seen. And then I come back and I show, over here, the perfect. And another thing too, that I hate is when people call us and they say, well, whole life's the worst investment you can ever put your money in. I always say, congratulations, you're really smart. You're absolutely correct. And I say that because whole life, even the specially designed one that I just showed you, is not an investment at all, because there's not an investment in the world that can use this word in it. Guaranteed. Guaranteed. Say that with me. It's a beautiful word. Guaranteed. When we were advisors, we very rarely got to ever say that. That was like a swear word. If you said that, someone came around with a billy club and smacked your ass. What'd you just say guaranteed about? Huh? Did you tell compliance you said guaranteed? Because that's like jail time. But in this world, we just use it freely because whole life is guaranteed, which means whole life is not an investment at all, because an investment is something that involves risk. There's zero risk here. Zero. 100% guaranteed interest rate contractually for the rest of your life.
Yeah, and so let me give you an example of what one of these looks like when it's properly built. So this was a policy that I did for someone earlier this year. They're out in 41-year-old female. She was out west, I believe Oregon or Washington, but nonetheless. So this was a real estate investor. And so this is what a typical policy, this is what we would call an illustration. So when you decide that you want to create your own banking system and start one of these specially designed and engineered whole life policies, it's going to start with a phone call with myself, with Chris, with one of our other money mentors. And we're going to talk to you about what your goals are, what you want to use this policy for. We're gathering information that's going to allow us then to take that information and build the perfect policy for you, like we just talked about, with the mix of the base, the PUAs, the term, the high cash, the boosters, and everything else. Okay. So this situation right here, she told me she was a real estate investor. She just got a nice chunk of change. It's just sitting in the bank right now. The bank's paying her like 0.01% in her savings account, and she knew there's a better way. So she watched our videos and said, okay, I like the way this looks. So let's start one of these policies. Now, when you start one of these policies, it takes time. There's a full medical underwriting involved because it's life insurance. So it's about a 6-week process from when you say, let's get this started to when you're actually approved and you're ready to actually get started with it, okay? But during that time, you're going to go through medical underwriting and a medical exam and all this stuff. But more importantly, we're going to design your policy for you and create what you see on the screen right here, which is your illustration. So this shows you how your banking system, your policy is going to perform for the rest of your life. So you can see right here, I have the first 15 years of this policy on the screen. So let me just point out a couple of things that we were just talking about. First off, this policy would be what's called a 65-35 design. All right. So it's not a 90-10. It's not an 80-20. This is a 65-35. But look how powerful this is when it's built the proper way. So in this case, she wanted to put $50,000 a year into this policy. That's what she was comfortable committing to put into this thing. However, she had an extra $100,000 sitting there right now because of a real estate deal that she had just got done with, and the money was just sitting. So she said, well, I'd like to put that extra money in the policy, but I don't want to put it in every single year. I just want to do 50 a year. Great. We can do that. We call it a one-time dump in. So you can put a much larger amount in the first year than you do the following years to kind of jumpstart this thing. So let me show you what that looks like. So in the first year of this policy, she puts $150,000 into it. Now, when she does that in the first year, she's going to immediately, within 30 days, be able to borrow back out some of that money. Not all of it, because again, it's going to take the rocket ship a little bit to get going for you to become efficient, to burn off some of that initial gravity before it starts going. Same thing with this. It's going to take a couple of years before you really get the full advantage of that thing up into space. All right. So this one, 150. Now in the first year, she's able to take back out of the policy $132,000. So we can do the math on that, but that's not bad, right, Chris? I mean, for a 65-35 design, a lot of people are like, well, I want a 90-10, I want higher cash value. That's probably about 90%, all right?
Absolutely.
So let's look at year 2 of this, all right? Year 2, put $50,000 in. Now she's able to pull back out right about $48,000. So still a little bit less than what they put in, but look what happens in the third year. She puts $50,000 in. Now she's able to pull back out over $50,000 from this thing. So I mentioned earlier, how many of you would want to own your own bank? And if that bank came with an ATM machine, that every time you deposited money into that ATM machine, the next day you could pull more money out of that ATM machine than you put into it. And everybody wanted those ATM machines, right? Well, here's your ATM machine, because look what happens with this thing. Every year that I put money into this policy, I'm pulling more than I put into it back out. And every year that I do so, it becomes exponentially more and more and more. I mean, look at this thing. In year 11, 51 years old, I put $17,500 in. I can pull the next day $45,000 back out of this thing. $17,500 back in the next day, the next year, $47,000 back out of this thing. I mean, look at that. Year after year after year, I don't even have the rest of this on here, but for the rest of her life, that's what this thing's going to do. And let's say she's making great money. She's loving life. She, some kind of disaster happens and she passes. Well, worst case scenario, look what just happened. She has this nice, big, beautiful death benefit that's going to get paid out tax-free to her beneficiaries. So that's like an added bonus. Again, that's the death benefit's not why we do this, but it's not bad for helping with a legacy, generational wealth, for helping your kids and your beneficiaries and the people important to you in life. So this is just want to give you a quick example of what one of these policies looks like. This is one that I actually created yesterday. So look at this thing. So this one was, he had a big chunk of money sitting there, but not ready to commit a huge chunk annually. So he said, okay, let's put $100,000 in and then $1,000 a month starting next year. So $12,000 a year. So the first year we put $112,000 into this thing. Immediately when we do that, the first year, look what we can pull back out of this thing. $105,000. What's the return on that, Chris?
Well, not the return. I'm just going to do the percentage that, the percentage you can take out. So 112, that's holy crap. That's higher than most. That's 93.9% of the money that he puts in, he can take out in the first year.
So what do you think that this policy is built as? If you had to guess, like, what do you think it's 90-10?
65-35. It's definitely, this would never make it through MEC rules in a 90-10. This wouldn't make it through MEC rules in a, hell, I don't even think you could do an 80-20. It's got to be a 35-65.
I believe it's a 50-50 actually.
It might be because you got such a big dump in to such a small premium. You're literally riding the MEC line. Scroll down a little bit. I bet you it shows the MEC line. And I bet you're $100 or $200 off of that MEC line.
Yeah, I'll do that in a second. I'm on the wrong. Let me change back over to the selector, but real fast, just to show you the rest of this, and then we'll look at the design of it itself. But look at the second year, 12,000 in. we now have $14,500 available to pull right back out. So this ATM machine, look how fast this thing became efficient. Why? Because I talked to the client about their situation and what their goals are. Their goals were to get that $112,000 into something today that's growing better for them than the savings account that they currently have it sitting in, while still having full control to take the money out when they need it to invest into their business. Now, what we're gonna do with this policy is he wants to use the money for his business, but the business is an LLC, it's a pass-through. So for him, it's more smart to have a policy owned by him personally that he can use and then lend the money to his company and allow the company to use the money that way. So on our call, we can talk about if you have a company or a business or you're a real estate investor, should you have a COLI, which is company-owned life insurance, or a personal policy that you can still use for company business. So we can talk about some of the pros and cons of that also. But look at this thing. I mean, it's just amazing, the growth on this thing. I mean, look, every year he puts 12,000 in. Look how much more he can pull back out every single year that he has it. Just fascinating.
That is insane. Dude, that is a 50-50. Look at that. It's a 50-50. So like, folks, just take note of that. Like, I know a lot of people on here, you have to have seen some videos where they're just touting 90-10s. First off, you could never design this plan to be a 90-10. It would never, ever make it through MEC rules. This is a 50-50 because in this one, he needed that rocket ship, the base, to be bigger to hold more of that dump in and support that MEC rule. But I mean, like, look at the freaking cash on that thing. That's a beast, man.
Because we hear it all the time. You know, we hear it all the time. They watch these videos or they hear these other companies. Well, I only want a 90-10, or why did you bill me a 65-35?
I know, I hear it all the time.
We actually know how to build policies. We're doing what's right for the client and for you. And if you have an illustration, and this is what we do with our clients, when you start one, I'll hop on the phone, we'll walk through this, I'll show you everything. A lot of times we'll make tweaks. Somebody will see it and say, okay, actually, I want to do 15,000 a year, or let me add some dump in on this thing, or let me put less money into it, or hey, I need a little more cash value. Can we change it to 60-40? Can we play with the design a little bit? And this is all stuff that we do while you're going through the approval process. That approval takes 6 to 8 weeks. So let's get that started for you. And then we can tweak this thing, make the changes and make it perfect to fit your situation. That at the end of the day is what it's all about.
This one's a big boy. So this is he's a real estate developer. We work with a lot of real estate folks. He had he had about $1 million that he could dump into the plan. So that's what we did. We dumped $1 million in. It was just money that he had in one of his operating accounts. And then he put about 110, 200 in each year. Okay. Now this plan, we had to redline this. This thing was really tough, kind of like what Steven just did, but now we're just putting bigger numbers. So folks, don't get intimidated by the numbers being like, oh, I could never do that much. We could show this at 500 a month straight up. I've got an illustration where we do 50 grand dump in, 500, well, 491 a month, and they all look the same. It's just math. So how he did this is he put this money in, immediately took it back out and put it into his development deals. The next year, and he's not there yet, but he's going to put 110, 200 in. He's going to take 135 out. So let me just, if you were a real estate investor, you do things by cash on cash returns. So let's just do the math here. 135, 315. What I'm going to do, folks, I'm going to take this growth, which is the year over year growth, 135, and I'm going to subtract out how much money he put in, because we can't use the money he put in. That's just his own money. So 110, 200. So I subtracted 135 from 110, 200. What that does is that gives me the net growth. Now, when I say net, I mean net of the cost for a $22 million death benefit, net of the term cost, net of the policy service fee, which on this one was $50. And he makes in year 2, $25,115. Okay. That's his net gain that year. And then if we wanted to figure cash on cash, we would take that and divide that into the amount he put in. So let's just do that, divided by 110, 200. Now, many of you are probably not going to believe that this is real, but that is crazy. A 22 point, we'll just round up, 22.8, it's 7.9 cash on cash return. Folks, listen, like, here's the cool part about these illustrations we're showing you. Like, I literally had to do this. I just pulled this right out. This is from the insurance company. I'm not going to tell you what insurance company this is, but it is from the insurance company. So when you're looking at this, just understand that we're not making numbers up. These are printed right from the insurance company. The insurance company has got to live and die by these numbers because they put them there. So these are crazy. And a lot of people are like, oh yeah, but when you take money out, when he takes that million, he's got to pay interest. Correct. This is 4%. His loan interest rate for taking that 1,024,000 out the first year is 4%. So now some people are like, well, see, I told you it's not free. No one ever said it was free. It costs money to be a bank, right? So, but I guess let's just do the math. Like if the second year he makes a 22.8% cash on cash return, is anyone complaining giving the insurance company back 4? And if I were to just keep going, as you can see, like this year is kind of a weird number, but as that, it just keeps going up. So if I kept doing that return, we might be, I don't know, this one's probably 20, and then you probably got 25. Nobody's complaining about paying 4% when your money is compounding at this rate. It's just a cool example, just a cool way to look at them. And we could do numbers all day long on these things, but I just wanted you to see a couple examples on how these things work, because it doesn't matter. We know how to build these things. You can use your guy, your broke ass brother-in-law, your favorite financial advisor. I'd love to challenge all of you to do something. Find your advisor and ask them to build you an IBC policy. I'm going to just put a number on it. 98 to 99% of them are going to bring you back an illustration. And at the very top, it's going to say IUL, or Index Universal Life. Mark my word, that's what they're going to do, because that's the highest commission product. Like they don't want to take the reduced commission. They want to make more than 5,500. So 500, they're not getting out of bed for that. But see, the way we do this, and a lot of you might even be thinking, well, why would you guys build them like that if it reduces your commission so much? Well, okay, let's just do bare bones, 10 grand. Let's just say everybody did only a $10,000 policy, and we made, I don't know, it depends on the design, but let's just say 500 to 800 bucks. Let's just use the higher. Okay, 800. Still a hell of a lot less than 5,500, but 60. Let's just do 6,000 times 800. Nobody's complaining that we're getting a lower commission. Matter of fact, Stephen, and I know you're this way. I don't even know what I make in commissions. I don't look. I don't even look. I'm just like, how many more lives and how many more people can I help solve their problem? And if we do that, we just make enough money to have a large staff, provide all sorts of features and benefits and customer service to our clients that nobody else can, because they're so focused on making the most amount that they can by selling you a high commission policy that doesn't benefit you. Almost all of them are called Index Universal Lives, and they are garbage. We could back it up front ways, sideways, upside down, backwards. I will literally get into fist fights arguing that IULs for IBC do not work, because they don't. We've proven it. We've even gone to the heads of these insurance companies that develop them, and they're even like, yeah, well, we got some issues with them. You just got to go with the people that know how to do it. I didn't mean to steal your thunder, Steve.
It's good, man. It's good. I love that illustration too. It shows a great example of a big policy. So let me just show you a couple more things real fast. Kind of getting back to what we were talking about before with being the bank, and somebody was asking a second ago about can they do monthly payments or a smaller policy? So yeah, I mean, absolutely. I mean, we showed you $1 million with 100,000 a year. We showed you 100,000 dump in with 12,000 a year. Well, here's one with a 50,000 dump in and $491 a month. So, you know, or you could do no dump in and just start putting a few $100 a month in. I mean, as a guideline minimum, we would recommend 10 times your age on a monthly basis. So I'm 39 years old, $390 a month. If I'm 52 years old, $520 a month. So that amount or more would be kind of like a guideline like a kind of a guideline minimum for your first policy. And if you can do some dump in on top of that, great. If not, got to start somewhere. You got to start building wealth. And we're going to talk about the wealth building in just a second. So just wanted to point that out. And again, you can put the money in annually up front each year, biannually, quarterly, or monthly. And each year you can choose on the frequency of how that money goes into there. All right. So let's get back to—
Hold on, Stephen. We just got a comment that has to be addressed. This is exactly what I'm talking about. So Dion said, how does this compare to MPI? Okay. MPI is a kind of made up name. I'm not going to give the agent's name, but don't worry, you won't see him in the next few years. I'm sure of it. So MPI is an indexed universal life that I was just talking about. So the MPI thing is just how he puts it together so that it works for retirement. But if you knew what I knew about our boy Curtis and his MPI, you would run as far as you can away from him. But I'm not going to say anything bad. Not going to say anything. Yeah, look at George. Oh, no. Yeah, you got me started. All right. But just be really careful. I know he's got a lot of followers on TikTok. I know he does really well, but believe me, there is some serious issues under the hood of that car right there. So MPI, man, that sucker, that's like one of those kit cars, right? You buy it on the outside. You're like, oh my God, you got yourself an authentic Cobra. You open the hood and it's a Volkswagen Beetle engine in there. Like, be really careful with them. I'm not going to go down my tangent on that, but I'm done.
Yeah. And so we're so we're talking a lot about these whole life policies, using this as a vehicle to be the bank. What does that really mean in the real world? Okay, now I'm starting to put my money into this thing. I see the growth of it. I see the cash on cash returns. But what does that really mean for me? Like, how am I controlling my money? What can I actually do with this policy? Okay. So we were just talking about a minute ago, when you put money in, you have the cash value that you can pull back out to use, right? Okay. What that means is when you pull the money out of the policy, you're not actually withdrawing your funds. What you're actually doing is you're taking a loan from the policy and you're using the cash value within your policy as collateral, and the insurance company is actually lending you money from their general account. Right. So what happens when you do that, and the reason why we do that, is because when you lend the money out of the policy that way, it allows all of the money to remain in the policy, compounding and growing. So everything that we talked about with that perfect investment a minute ago, it gives you the uninterrupted compounding, tax-free, guaranteed growth of your money consistently every year for the rest of your life, even while you're simultaneously pulling the money out to use it. Okay. And over the last 15 years, I've really boiled it down to two laws for creating and growing wealth. So law number one, and Albert Einstein actually said this best. Albert Einstein called compounding interest the eighth wonder of the world. He said, those who understand it, use it. Those who don't, pay it. So think about it. Every dollar that you put into this policy that we just showed you on those illustrations, it's compounding, uninterrupted, guaranteed, tax-free for the rest of your life, period. Rule number two for creating growing wealth: money movement and flow. You have to keep money moving at all times to make more money. See, when I have money, Chris, when you have money, we always want our money to go out there and make more money for us. So we're always looking at investments. We're looking at things like real estate, like private lending, like new businesses. We're looking at ways to grow our wealth. We look at even things as simple as US Treasuries. We look at things like I bonds. We look at diversified investments, gold and metal and precious metals. Why do we study this? Why do we invest that way? Because that's keeping our money moving at all times. So why do we use this whole life policy to become the bank? Well, A, it gives us full control, because every dollar we put into it takes advantage of law number one on this. And every dollar that we put into it, we have the ability to pull back out immediately and put that money to work and make more money for us. So we're able to do both laws of wealth simultaneously. And I do not believe there's another vehicle that exists in this world that allows us to do both of those things simultaneously that way. Does it exist, Chris?
Nope, not that I found. The closest thing I've ever found that allows you to do that would be is if you were a pretty wealthy individual and you had, you know, a couple $1,000,000. Each brokerage has a different dollar amount, but let's just say it's 5 million in a brokerage account that's invested in stocks, bonds, mutual funds. They'll give you a margin account at a and that actually isn't going to work now, because the margin accounts interest rates are going up and up and up with the Fed raising rates. But back when we were in a low interest rate market, that was the closest thing. But you still had the risks that came along with the underlying stocks. The margin was just a loan against your portfolio balance, and that works kind of the same. But I bet you everybody that was using those accounts in this environment are probably like, oh shit.
Now, when it comes to using these whole life policies this way, it's not the product as it is much the process of how we do this. So again, starting with the design of the policy, building it properly for you. But then once you actually have it built and you're approved and you put your money into the first time, that's really where the real work begins, because having the money sit in there and grow and compound for you is great. But the real power of this is law number two right there, with the ability to pull it out while the money continues to compound and use that money for other things. So that's what we call the infinite banking concept, or IBC. That's where that comes from, is this strategy of using that money from the policy to do other things. Now, when it comes to the infinite banking concept, there's literally an infinite amount of ways that you can use these policies, from everything from everyday bills to investments to paying debt and everything in between. Now, what we focus on and what we're going to train you on are 3 specific areas for using these policies. And if you go back and you watch the full Money Multiplier Infinite Banking presentation, we give you incredible examples of how to use these policies. We're not getting into that today because we're focusing more on growth, but I want to go over those just to make everybody clear. So number one, we're going to show you how to be able to pay off debt. Does anybody in here have any debt? it seems like the more money you make, the more debt you end up accumulating, just out of the way things work, I guess, the universe. But nonetheless, we have a lot of successful people. Like there's a chiropractor, for example, that we use as an example in the training video on how this chiropractor made great money, but he found himself with $450,000 in third-party debt. And we show you how we started a banking system for him using these policies, and where it would have taken him 19 years to pay off that debt. We were able to do it using these policies and the infinite banking concept. He paid it off in 6 years, all of that third party $450,000 in debt. And the entire time, not only did he pay it off quicker, but he continued to build wealth for him and his family for the future. So if you have debt and you like to be able to pay off your debt quicker while still building wealth, this is an excellent concept and strategy to use. Number two, if you like cars, or you like major purchases, or you like spending money on things, this is a great strategy. And in that training video, we're going to show you how to get back every dollar for every car you'll ever buy, drive, and own using the infinite banking concept and the specially designed and engineered whole life policies. Just to give you a quick example that just recently happened, one of our partners, Devin Burr, Mr. Burr on social media, a lot of you guys probably know him. He just bought a $250,000 Audi. Guess what? Over the next 5 to 6 years, he's going to get back every single dollar that he spent to buy that Audi. And he's actually going to make a little bit of money driving it just because he bought it using the infinite banking concept. Now, whether you're paying off debt or whether you're making major purchases and recapturing all of that money, you're going to be able to do that with this whole life policy and using the infinite banking concept. And here's the best part. Like I said, is once you have the policy and you start it, that's when the real work begins. That's not the real work as much for you as it's the real work for us. So what the money multiplier has done is it's created a team. We call it the mapping team. And this mapping team, all they do is work with you to use your new policy and teach you how to do banking with it. So the first thing you do as soon as you're approved and you fund that policy, you go to the mapping team. You say, hey, I got a few credit cards. I got some student loans. I got a couple car loans. I got my mortgage, and I got my new policy that I'm doing infinite banking with. And the mapping team is going to talk to you about your financial situation. They'll do a cash flow analysis with you. They're going to go through all of your debts, and they're going to create what's called a debt map. And they're going to show you the exact plan to follow using your new policy to pay off that debt even quicker, just like the example that you see on the video with the chiropractor. So we do all this for you. If you want to buy a car, we'll show you how to create that car repayment recapture plan to get all the money back for you. And here's the best part about the mapping team. It's free. You're never going to pay us $1 for any of the stuff that we've been talking about here today. The consultations, the planning, the strategy, the policy design, the mapping, the using it for life. You're never going to pay us $1 for any of that. We make that small reduced commission. We just do a lot of business. We do a lot of quantity. And that's how we end up making money with this stuff. So that's how it works. And we're going to create that for you. So those are the two most popular ways for using policies. However, if you're like Chris, if you're like me, if you're like a lot of the people on here that they don't have any debts anymore, they paid them off. They don't need to buy any new cars or major purchases. They want to grow their wealth. They want to preserve their wealth. They want to start creating a legacy and generational wealth for their family. Well, that's where the third use of this policy comes in. And that's for growing wealth. And that's for investing. And that's where the fun begins, because that's where we can start using these policies in conjunction with the uninterrupted compounding to grow our wealth even more. So how do we do that? Well, the ways that we do that specifically, Chris and I, at least, we focus a lot on these areas that you're going to see on the screen right here. And this is what we're going to teach you at the 3-day Money School Essentials training that's coming up next weekend. So next weekend, November 11th, 12th, and 13th, we're going to get in deep on these subjects using self-directed retirement funds, using infinite banking policies, using leveraged money like HELOCs and refinance money, things like that, to invest and move your money in these different types of asset classes safely, and how to do it the right way where you're protecting you and your money, and you're able to grow wealth for your family. So this is all the stuff that we're going to get into. And just to give you one example of what this can look like for you, and then I'm going to turn it over to you, Chris, for a minute. But check this out right here. So this is a quick example of what this looks like. All right. So let's just do a private money loan right now. So a private money loan is, let's say Chris is a real estate investor and he has a house that he's flipping, and the house is worth $250,000. And Chris can buy that house for $100 grand. He could put $50,000 into it, and then he could sell it for $250. Okay. But for Chris to do that deal, Chris needs $150,000. And right now, Chris has a couple other deals going on that he financed with the bank. So the bank will not give him any more traditional financing. So if Chris wants to do that deal that has incredible returns, incredible profit margin, it's very safe, it's a very low loan to value ratio. Well, Chris needs something called private money. So somebody like me, I have a self-directed IRA. I have infinite banking policies. I'm looking for ways to move my money to make more money. So I say, hey, Chris, you need money to get this deal done that has great profits and returns. And I have the money to make that happen. I'm looking to grow my money at 12% annually. How about I lend you the money in first lien position? You give me a mortgage and a contract known as a promissory note that says I'm going to perform by the terms of this contract and I'm going to pay you 12% annually on your money. Will you give me the money? I'll say, absolutely, let's do it. So if you don't know what I'm talking about, don't worry. That's why we have the private money club. And that's why we're doing the training next weekend to go into depth on all this stuff. But that's what's known as a private money loan. Okay. So I lend my money to Chris. It's backed by an asset in real estate in first lien position. Guess who else does loans like that? The banks. Remember, the entire topic of this is be the bank. So we're going to do what the banks do. So if banks are lending their money to people in first lien position on houses, is there any reason I shouldn't do the same thing? That's exactly what I'm going to do. So I'm going to lend Chris the money. So what you see on the screen right now is an example of that. All right. So what we do is we take the money, in this case, from our policy. So this is the new whole life policy. We lend the money over, or when we take the policy loan, it goes into what's called a segregated bank account. The segregated bank account, by the way, is just a separate checking account, nothing special, just somewhere to flow money through so we can account for it and we can track it. Okay. So the money goes into the segregated account. From there, I lend it to Chris. Maybe I found Chris's deal in the private money club, 12%. Now, once I lend the money to Chris, Chris is going to start paying me monthly interest payments. I'm going to take that money. I'm going to keep some of the profits from the spread, and the rest of it is going to go right back into the policy. Why? So I can do this over and over and over again. Remember, money movement is the word here. Money movement. We're going to keep that money going over and over and over again. So let me show you what that looks like in reality. So this is that exact same policy I just showed you. 150 and 50 a year going in. But here's the difference, okay? If I was to use this policy to do a private money loan, let's say in this 8th year of this policy. So in the 8th year of this policy, I put $58,000 into it. It grows by $66,000. Chris taught you guys this a minute ago. It's called cash on cash returns. All right. So if I take out the $48,000 I put in, it gives me $18,000 in growth, which on the $48,000 injection is what's called a 37% cash on cash return. So that's the internal tax-free growth of the policy. Now, if I take the money out of the policy, the insurance company is going to charge me 5%. So you see that highlighted right there, right? The 5%. Now, if I do the math on this thing, I'm getting 12% from Chris on the private money deal. My money grew within my policy at the same time, 37% that year. I had to pay the insurance company 5% to use that money, but it grew by 37%. So that's okay, right? So at the end of the day, by doing this deal, using this policy and doing this private money deal, I just grew my wealth by 44% that year. So remember, I didn't do anything different here, except 8 years prior, instead of putting my $150,000 into somebody else's bank, I put that money into my bank. Instead of each year thereafter putting my savings into somebody else's savings account bank, I put it into my bank, which is my new policy. And by making that one change where my money goes first, I was able to get a 44% return on my money that year, as opposed to a 12% return on my money that deal, doing nothing different. So you tell me, would you rather make 12% returns or 44% returns? That's the power of being the bank and becoming your own banker and having control of your money.
And the funny thing about looking at that is a lot of people would look at that and be like, there's no way, that sounds too good to be true. But that just shows how little we know about compound interest, which has been around forever. I mean, it's just mathematics. I mean, Albert Einstein understood it. And that's why he said, those that understand it earn it. Those that don't pay it. I mean, that's all that is. It's not magic. It's not like some great return the insurance companies are paying. I mean, most of the insurance companies are between 5 and 6% with dividends as of right now. Nobody's getting excited about that. Actually, if people just heard just that number and ignored everything else we just taught this whole time, they'd be like, oh, inflation's 8.2, you're losing money. But they didn't take the next step. We're not telling people to put money in a whole life and just leave it sit there. We're literally showing you how to put it in and then to follow a process called the infinite banking concept and move that money into various different things. There we showed an example of a private lending deal, which it's kind of funny, Stephen. I just drew it out on the board. I didn't even know you had that slide. It's pretty good here. I did 150 because I used your number. I lent it out. That policy was 5%, and I did a 12%, and I just showed the 1,500 coming back. So, man, talk about thinking the same. But yeah, that's basically how it, and we're going to go deep into this stuff, and we're going to go into a lot of the questions on the 3-day. So folks, please get your tickets for the 3-day event, which is, I believe, next weekend, November 11th through the 13th. It's amazing how fast time goes. So grab them. The link is right there in the description. But Stephen, I want to take a couple of minutes, and I just want to rapid fire through these questions. We got lots of them, and this isn't one of those webinars where we talk, and then like at the end when everybody's asking questions, oh, buy our course and we'll answer your questions there. We want to answer them now. So that's a true story, isn't it? Shauna did this whole webinar from a guy that did something, quote unquote, like what we did. And at the end, people were asking great questions, she said, and he wouldn't answer any of the questions. He said, well, buy the course and then I'll answer your questions. It's like, that's putting the cart in front of the horse, man. Let's let the horse run.
Hey, real fast breaking news. Fed raises rates 3/4, 0.75 basis points again.
That's what was expected. That was expected. So nothing to see here, folks. Nothing new. Let's see. What did the markets react?
They bounced 200 points.
Of course they did. Because the market, because the market anticipated a 75 point. It's so ridiculous. Anyway, yeah. So all right,
they hinted at possible slowdown in the pace of increases as well. So, all right, how does a person minimize the losses and leave the 401k trap without too much bloodshed?
Well, I mean, it's a tricky one. I don't like people some people are like, oh, I'm just going to close down my 401k, pay the penalties, pay the fees. I don't like that, because then you got to, you're going to lose whatever the taxes and the penalties are. And I just don't like giving the government money. So it's a tough one, because you've got, the easiest way to draw that is essentially you're talking about qualified money moving to non-qualified accounts, like what we just showed. And in doing that, as soon as you cross that line from qualified, which is your 401k, qualified retirement plan, into the non-qualified side, you're going to trigger tax and penalty if you're under 59.5. So to do that, you got to be willing to pay this. And I would say get with your CPA before you ever make a move like that, to see what kind of impact that's going to have from a tax standpoint. The other way we've seen people do it, and it's not something that we do a lot of teaching on, is we've seen people take loans from their 401k. You can take 50% or 50,000 max. And we did a lot of this during the pandemic. We were definitely teaching it then because it was a unique opportunity. And then they move that loan over here into the policy. So they set up their IBC policy. They use the 50,000 as a dump in, and then they figure out, all right, every year I want to put 12,000 a year in, whatever it is. And then what they do is they loan that money out on real estate or do something with it. And then they take the money from the real estate. I know this is complicated, but they take the money from the real estate returns and they pay back the 401k loan to avoid any taxes. So that's how I've seen it done. You got to be very diligent with that, because if you screw that up, you're going to end up paying tax. That's why we typically don't teach that. But that would be the only way. Stephen, anything you want to say on that?
No, I mean, depending on your tax situation, work with your CPA. I mean, if you can pull it out over time, we can always do like a multiple year dump in if we need to. So we can structure them different ways depending on your situation. Outside of that, if it doesn't make sense to start paying taxes now, depending on how old you are and whatnot, it might be better just to move it to a self-directed IRA right now, especially if it's an older 401k and you're allowed to move it. And then that way we can at least control the money and get into some of these alternative investments out of the stock market. And then, maybe start pulling the money later on once you're not paying penalties and things, but there's just a lot to that. Will says, why wouldn't I budget my expenses and put the remaining of my W-2 income into the policy every year to maximize cash value versus only putting in 10,000 a year?
Will, a lot of people do that. That's actually not a bad idea. Just leave a little buffer in case your expenses go up.
Yeah, nothing wrong with that.
No,
there's no reason to limit yourself to 10,000 a year by any means. All right. So when you say pull out, does that mean not change the face value?
Every time you're going to take a loan.
It is a loan, so we're not actually taking money out. And it doesn't affect the face value, but it does reduce the death benefit of the policy if you were to pass away. So if you have $1 million death benefit and you have a $200,000 loan out of the policy at the time of passing, the insurance company is just going to say, okay, the $1 million minus the $200,000, and then pay out the $800,000 to your beneficiaries. So that's what it does.
Yeah. it's just always going to be the subtraction of the loans, because the insurance company, that's why they're willing to give you the death benefit. They got to pay it anyway. And that's also why it's tax free, because the loan by IRS standards has to be paid back. Now, it doesn't have to be paid back in your lifetime if you don't want. We always suggest you do that. But when you die, it's paid back just because they reduced the death benefit.
Another good one. If you start with 12,000 and 100,000 dump in, can you upgrade the annual premium without starting over with medical and a new policy? And the answer is no on that. So we have to work within against the IRS guidelines called MEC. And so that prevents us from getting more into the policy than what it's designed for up front. But if you start a second policy within the first year, a lot of times you don't have to go back through medical and things like that. Afterwards, it's up to the insurance company. You might not, but you will have to go through underwriting. But that is how you do build your banking system, though. So once you do max out, how much annually you're putting into your first policy, whenever you want to start putting more in than that first policy will hold, that's when you just start opening up additional policies and stacking them to build your banking system. And then each new one, we can design it a new way, depending on what fits your needs and so forth, so on and so forth. So good question. These examples have large dump-ins in year one, so cash value is high, then it goes to roughly what the yearly deposit is. Can you only access a percentage of your yearly deposits versus the growing cash value of the policy overall?
So it's kind of,
no, you have access to all of the cash value.
You can access, the cash value that's available. Typically, the insurance company, depending on your mode of premium, they'll usually give you 90% of your available cash value because they want to hold some back in case you miss a premium or something. So, and that's really for your protection. So it's not that the money's not there. It's just they won't let you take 100% of it, because if you didn't make your premium, your policy would lapse. So they usually will do a 10% holdback. That money then, just sits in the account and, all the money earns interest. But that's a good question. So it's usually 90% of available cash value that the insurance company allows you to use. And then you're talking about the dump-ins. So the dump-ins do juice the policy up in the early years because you got all that money earning compound interest right out of the hole. So if you did a policy that didn't have a dump-in, you might not have, like his example was 93%, mine was 92. It might be more like 80 or 85%, but it's still really good. It's just, you just don't have that extra tailwind of interest on the money. So your available cash is slightly lower, that's all.
Can you speak about the premium financing policies? Curious on your thoughts.
Yeah, premium financing has been very popular in the prior years, especially for long-term goals. Like if you want to retire, or in business uses, if you're using policies to put excess surplus capital, the premium financing is essentially you go to a bank. So now we're bringing the bank back into the mix. The bank is going to give you a loan that will be secured by the cash value. Okay, so you qualify for the loan. The bank puts the money in the policy. Now here's the problem. Everything you just saw us teach you goes out the window when you do premium financing, because you're not going to have liquidity of the money because the bank's on the hook. Bank's not going to let you take their collateral. They're smarter than that. But it does allow you to get a lot of money into a policy that will grow for a future need. I've seen premium financing work effectively with whole lives like what we build in the long run for more like supplemental retirement planning. But the problem with premium financing right now is as the Fed keeps raising rates, just today, another 75 basis points. I mean, your premium financing comes from banks. So the bank interest rate is now really high. I mean, it was very effective when we were in the low interest rate cycle because heck, you could get loans 2-3% sometimes if you qualified. Now, I don't know what those loans would be. I bet you stop hearing about premium financing because it's just not mathematically going to make sense at these higher interest rates. And I know some of those premium financing loans had variable interest rates, which, God, I can't even imagine the lawsuits that'll come from that, when those interest rates get so high that the policy won't support itself. It's just you're just adding an element, what would be the thing when you put an animal in a surrounding that's not like it's usual, you're taking a bank loan and you're putting it into an unfamiliar territory, being the life insurance policy. You're now losing control of your money because the bank's in control. So I don't love premium financing, but there are good uses for it.
What do you say the policies you build are called? Sorry. So it's just whole life, especially designed and engineered whole life insurance.
Yeah, from a mutually owned company, meaning not a stock, company, and or publicly traded company. And then also one other thing that I saw in a chat earlier that's important to kind of look at, and it can go both ways, but we tend to lean toward non-direct recognition companies. Now that gets complicated. There's direct and non-direct. And all it means is a non-direct recognition company, like we just taught, when you take the loan, it doesn't affect your dividends. Like the insurance company does not recognize, just like it says, non-direct, they don't recognize the loan. So therefore, it's kind of like the loan doesn't affect your dividend. But in a direct recognition company, when you take a loan, it affects your dividend. So it will drop down the dividend because that loan is being recognized by the insurance company. So we do both. We do direct and non-direct, but usually we will tend to lean toward non-direct if a line of credit isn't being used.
If you take a loan on your policy and don't pay, can you make another loan in the future? Yeah, you can take as many loans as you want. You don't have to repay them. It's completely up to you. You're in complete control. So if you take a loan, your cash value builds the next year, take another loan, you could take a partial loan, pay some of it back, pay none of it back. You're literally in complete control of all of that. What if you can't make a couple of monthly payments back into the policy? If you're talking about loan payments, Sam, it doesn't matter.
Yeah.
So if you skip some, if you have yourself skid up on like monthly loan repayments, just because you're following the infinite, your mapping plan, and something comes up, it doesn't matter. It makes zero difference at all. Just get with your mapping agent and they will update your map for you to allow for those months that you weren't able to repay the loan. Madeline said, when you are the owner of another adult, does the insurance company look at your income or the insured person's income, or either or? Madeline, they actually look at both. So if you're the owner of somebody else's, they're going to look at both the life and your financial situation. Shelly said, not sure if you guys discussed this part or not, but I can move money from my self-directed IRA to this whole life policy. So no, you cannot do that. So anything in a retirement account, like an IRA or 401k, that needs to remain within that tax shelter vehicle per IRS regulations. So you cannot invest in a whole life policy using that money. Whole life's not an investment. If you were to take the money out of one of those, then you're just going to be paying taxes or penalties or whatever your situation is. So you can't cross streams on those by any means. Policy. Given the higher interest rate environment, will mutual companies compete to give more dividends to attract customers?
Ooh,
that's a
good question. I can hit that one.
Yeah.
You can only go back in history to look at this. Right now, 2022, we are at one of the lowest dividend scales with all these companies we work with, these mutually owned insurance companies. And I have records back 34 years. So we're at the lowest dividend that they've ever been at. And if you historically look at other dividend periods, like the 80s, the 90s, the 2000s, when we were in a higher interest rate environment, dividends were significantly higher. So if we just take what happened in the past and we look at the future in a rising interest rate cycle, today another 75 bips, yes, dividends more than likely will go up in the future. I doubt they're going to go up in 2023 because I'm sure a lot of the insurance companies are going to pad their coffers and make a nice little spread for 2023 and maintain dividends. But I don't know. I mean, dividends aren't released yet, but I bet you if I were to guess, and this is totally guessing, I don't know this. So disclaimer, this is just my opinion. I would say 2024, you'll start seeing all these mutuals start raising dividends and continue to do so into the rising interest rate cycle. Do you think the Fed will enact Dodd-Frank bill that passed in 2016, giving the big banks the ability to take your bank deposits to bail them out, kind of like what happened in Greece? This would seem like all the more reason to get your money out of traditional banks. So that would be drastic. I can't see that happening anytime soon, but is it something that's off the table? Definitely not. If it's happened in Greece, it can happen in the US, but I wouldn't worry about that. I wouldn't let that keep you up at night, but I would certainly take preparations to get control of more of your money so that the banks have less of it. It's good thinking, but don't let that kind of keep you up at night as a doomsday. How do you think raising the interest affects the interest borrowers are paying? It goes up. As you're already seeing it in Private Money Club. Just the last couple of deals that have been placed up there. I mean, the average, when we first started, was like 10, and then it kind of moved up with the interest rates going up. So average was 12. Now you're seeing a bunch of 15% deals on there. So it's all relative. All right, folks, I think we knocked out all those super quick. I didn't know we had another call, but we do. So folks, again, there's the link for the 3-day right there, moneyschooltraining.com/registration. So get your tickets and we will see you next weekend for the 3-day training. Thanks everybody for joining us with another week of Wealth Webinar. Anything you want to say on the end?
No, I was just saying, yeah, join us for the 3-day class. If anybody needs me, give me a shout, email, schedule a call with me. I'm here for you. If you want to see the full IBC training, if you're new to this, you can go to chrisnaugle.com. It's right on there, or visit the YouTube channel. It's where we put the recordings, and I do it almost every Tuesday night, also live if you want to hop on one of the live ones. But our full schedule is available. You can follow us for all the webinars. Join us at 4:30 Eastern today in 2 hours for the Ask Me Anything, where our entire team is on, and we're just going to continue to answer more and more questions about banking, IBC, money, investing, and anything else you got. Thanks for being here. We'll see you guys next week.
All right, folks. See you next time. So I hope you guys enjoyed that episode. We're putting up tons of them, but I think if you like this one, you'll probably like that video as well. Not only that, I've got a book that I created, Mapping Out the Millionaire Mystery, where we actually show you what the wealthy do in the game they play with money. I want you to have that for free. And if you want to know about all my new videos coming up, click that alert button. Actually, smash that alert button, and you'll be notified every time we put a new video. So we'll see you on the next episode.